Hello guys, and glad to have you on board again today. We add up to the educational series talking about a specific context today about the yields and specifically the yield curves. Because of course, this is definitely not going to be a boring economic video or whatever. I'm not an economist, never will be, and I am a trader, so I'm going to teach you whatever it is that you need to know about yields and yield curves in a trading perspective. So forget about the economist bullshit. Most of them are not traders, so you're certainly not going to be looking like a brilliant economic guy in any party or whatever, but you are going to have at least the bare minimum to understand how the Fed acts according to market conditions. And so let's get right into this. Okay, so basics first. When we talk about yields and the yield curve, we're talking about government bonds, even though these techniques could eventually be applied to some other bonds. I suggest you stick to the original version of it, which is government bonds, and specifically the study we're going to do today is on the US government bonds. So the least you need to know about them is that there are multiple of them, different maturities, which means when you're lending money to the government, you can lend them on different scales. You can lend for 1 month, 3 months, 6 months, a year, 2 years, 5 years, 10 years, 30 years, 20 years. Okay, so different maturities, of course, and these different maturities have different yield. Okay, so that therefore comes the yield curve. The yield curve is no more than that. We are putting all of the yields over different maturities in a same chart, and that produces a curve. Normally, if you understand what a yield is, or at least the basic of it, is the risk or the reward you will get for the risk to lend the money to someone else. Of course, a yield comes from multiple factors, the underlying factor being inflation, because if I lend you $10,000 today, and if you restore $10,000 to me 10 years from now, I just lose money if there is inflation in between. Okay, so of course, yield is supposed to compensate for inflation and the risk of default, which is the reason why we're going for the government bonds, because governments cannot default. So the premium for default risks are near zero when it comes to government. That's not a certainty, but for the US government, let's take it that way. Okay, so there is no risk premium for default. All we have is a premium for inflation. So what we look for in here is not the effective rates and yields, but we're going to study how the curve reacts. And then we're going to look at some other metrics, because what we care about doing in here is not to predict the yields, because we don't nearly give a fuck about them. If you want this, stop that video now. This is not what I'm going to deliver. What I'm going to deliver is predictive analysis with some decent statistical returns on what the Fed is about to do, because the Fed uses different tools to either prop up the economical conditions, financial conditions, or tighten them. And this has been the center of the maze and of so many discussions recently, not to mention so much crap out there that I really wanted to finally take the appropriate amount of time to deep dive these things so you guys know the essentials. This is what we're going to talk about, and this is what you need to know about yields. Not how they function, but how to properly use them in your trading analysis and trading perspectives. All right, so to set the basics, I have been using one method, which is the general knowledge one that most traders use, is to look for risks of recession by looking at the yield curve on specific maturities, which is the 2-year yield versus the 10-year yields. There is a general consensus in the trading community, meaning that when we get a reversed yield curve over these two expirations, basically when the 2-year yields more than the 10-year, though there is one thing you need to understand, okay? If I lend you money on a longer perspective, that means my risk to take on inflation is bigger, and therefore the higher yields maturity, call it 30 years, have to yield more than the 20 years, okay? And then the 10 years and so on. This is why normally we talk about the yield curve, which is supposed to be increasing as we go to higher and longer maturities, okay? So the shorter the maturity, the tinier the yield return is supposed to be. But of course, there could be some glitches. These glitches, even though I'm not going to get into too much details in here to make it easy, means that the bond traders at some point may do what we call a yield curve reversion, meaning that a shorter time frame yield will yield, a shorter time frame maturity will yield bigger than a higher and longer time frame one, which is not supposed to be normal. And that means that the bond traders were supposed to be not liars because they're lending money, so they do not cheat with prices and they do not fuck up with this. So this is supposed to be a trustworthy information, signaling that if the bond traders shift on the yields over different maturity to reverse that yield curve, that means they anticipate some shit down the corner in between these two maturities. Reason why when the 2-year yields is shifting against the 10-year yields, we have a tendency to say that there's going to be a recession between now and the next 2 years. Otherwise, there wouldn't be that reversed yield curve. Why do we use 2 to 10-year yields? Because, of course, the shorter the yield curve reversion you get down to, the likelier you're going to get the signaling, which means you're going to get more signals. They will be more precise because, of course, you're not going to have to wait until now in 2 years to get the recession if you go for shorter yield reversions, but you're going to get a shitload of false signals as well. This is the reason why I've personally always sticked to these 2 to 10-year yields reversions. But recently I just deep dived into this thing, trying to figure out if I could get a hedge and make this thing a bit better so that I could get a faster signaling without introducing too much noise. So kind of noise filtering this thing. What I came up with, I never thought I would get it. So this is the reason why I shared it today, because I think this work is definitely worthwhile. So let's jump into this. What I've done is not magic, just run a few math and try to find some other ideas and thinking outside the box to try figuring out how I could shift to shorter term maturities, yield curve reversions without, and still filtering out the noise, without going into too much complex computations and so on. So the idea I had is that, okay, if 2 to 10 years is very good in terms of signaling, but much delayed, which means the precision on timing is very, very shitty, well, I need to shift down. So what I've shifted is shifted down from 3 months to 2 years, which means when I get that reversion, normally the price reaction, or at least the Fed reaction, should be within the 3 months schedule, which is great. 3 months is not perfect. I'm not trying to time the Fed immediately by the next week or whatever, but 3 months time scale is pretty damn great. But the thing is, we're going to get shitload of false signals. So the idea I had is to try filtering it out by putting it into context. And therefore, I do not know how I ended up with this, but gosh, the first trade, the first attempt was so good that I said, well, I haven't found the magic system that predicts the future, but I found something definitely worth looking deeper into. By just doing this, looking at the spread between 3 months and 2 years, okay, and dividing it, putting it into context, kind of having the ratio between the spread of 3 months to 2 years, but putting it aside and compared to the 10-year yields. In that perspective, you know the entire yield curve is going down, okay, because all the yields have gone down for years. So if you put it into context, instead of having everything going down, you basically normalize and flatten this curve by dividing it by the 10-year yield. So you get the ratio of spread between 2 year 3 months relative to the 10-year yields over time. That gives us a flat curve, which is great. Of course, the negative values mean that we are in normal market conditions, the short-term yields less than the long-term ones, okay? Of course, when we get above zero value means the 3 month is yielding bigger than the 2 years. So we've got a short-term yield reversion of the curve, okay? That is what we care about. But in this perspective, what I like is that putting it into context and normalizing it with the 10-year yields gives me this nice curve in which I definitely can figure out a set of patterns. And we can see that over time, and as the yields tends to go towards zero, the shift, meaning the difference, okay, the delta between 3 month and 2 year is increasing in terms of volatility aside kind of a median value. Okay, what's great is that, of course, we have some ups and downs, some peaks and valleys, and more importantly, as we go along with this kind of average centered value, what matters to me is when we get to extreme standard deviations. And as we've seen, we said that these standard deviations are increasing over time. Okay, we're getting more and more shifts toward the short-term yield curve because of the shorter-term yields being closer to zero. And that's a topic that I'm not going to dive deeper into, okay? So this is the basic. By relating this to the 10-year yields, I've flattened the curve, and I've also been able to filter out most of the noise by seeing this expansion in the yield delta, which is great, okay? So I can now look at all the occurrences in which we have dipped below these prices. These mean reversion kind of signals in which we go so far away from the mean that we have some kind of signaling, okay? And we're going to study how the major elements of Fed's actions reacted according to these shifts, okay? We've got two shifts in here, and we have gone very rapidly in here. This is just noise, okay? The data never came up in here, came down in here, but prices did dip in here. If you want to have a quick look of it, okay, just for transparency purposes, you can see this is just statistical bullshit on the data input. As in here, you can see that value has been settled. We've settled multiple days in here. It's just not an ugly lower shadow value, okay? So definitely important to figure this out. All right, so let's put it right back into motion. This is where we are. All right, so over time, what do we look at? What are these other metrics? Okay, so the orange one is pure and simply the Fed funds, which is the Fed directive yields. This is one of their toolbox things in which they can control the basic yield curve by setting standard yields in which others will set themselves. Okay? Of course, over time, Fed has been loosening the monetary policy over these yields to the point we are today on the rock bottom of 0% Fed funds. In that perspective, we could eventually go negative. That would be one possibility, but some other argue that we'll never go down this road, and I personally stand for this. So we are in a rock bottom situation in which, well, we cannot set negative standard yield returns. So until further notice, we have a problem. Okay. The first solution to that problem that has been found is, well, we have a problem with one tool, yet let's create another one. So this is where these purple line came in. This is basically using the Fed's balance sheet to buy some shit in the market. First of all, of course, we buy the safest assets. We buy the bonds, okay? So the Fed's balance sheet has been introducing QE, quantitative easing, which is basically going into the open markets and buying some bonds in exchange for some money, which helps the market getting liquidity and taking over their safest assets. So bringing liquidity with a nice government bond collateral, okay? So totally understandable. As you reach out maximum power of your historical rate power, well, you have to find something else. Of course, some people may argue over this for a decade. We're not going down this road. Is Q good or bad? Whatever. It's just one of the tools the Fed have, and they've been using it because they had no other choice. Okay, so this is the second curve we study. The other one is the yellow one, which is no more than the S&P 500 divided by the M2 real, which is the M2 money supply correction. So kind of looking at market global valuation derived from inflation. Okay, so we put inflation out of this table so we get the pure row cycle. Otherwise, looking at the S&P 500 without it would be just a stupid parabolic scheme. Okay, so market pricing out of inflation pressures, Fed funds, which is one way the Fed can act upon the economical conditions and financial conditions, and the second one is the Fed balance sheet. What we're trying to figure out with this big thing is when we have these timings over these delta over short-term yields compared to 10-year yields reference points, so we get a neutral delta, is great. And what we're trying to figure out is if there is some kind of a correlation between the actions of the Fed on one of the two things. Are they triggering QE or triggering Fed rate tightening, or are they triggering the opposite thing of it, which is basically loosening the monetary policy? over the Fed funds rate, okay? Are they reducing QE? In that perspective, they just stop buying bond, creating this flat curve in which the maturities that are reaching their end are replaced by new bonds, which creates this flat curve in which we wait for expiration to terminate and we buy the amount of what's terminated, though the Fed is still buying, but at a much, much lower pace than when we are, of course, increasing the balance sheet in which the Fed is buying more than the bonds that are expiring. Okay, so considering it that way, there are different level of aggressivity or loosening the monetary policy. So you've got neutral rates, but after moving up. So when rates have been rising and then the Fed stabilize it, okay, it's one way of making things deteriorated over time. Okay, it's one way to do it. Of course, when the Fed is loosening the monetary policy and it goes flat, this is one way to stop easing. So it isn't bad, but it's less good of a financial condition. And consider that this number you see, these outcomes you see here is the lower we are, the better the monetary condition, the financial conditions are, okay? Because that means the bigger the delta between the 2-year yields and the 3-month. All right? When on the opposite hand, the higher means the worsen the financial conditions are. All right? So consider it out that way, and let's have a look at historical reactions when we reached out to those tipping points we figured out. Okay? So anytime we've gone up, okay, after Fed tightening on yields, anytime this happened, we had a Fed loosening policy. Every time. Okay. So every time the Fed is loosening the monetary policy over the yield curve whenever we get into deteriorated financial conditions. Okay? Well, that's one thing. Okay? Of course, when market prices tend to go down over these deteriorated financial conditions, this is where the Fed is seriously loosening the monetary policy by slashing the interest rates. Okay, then of course at some point we get some kind of a plateau because things cannot be forever good. In that perspective, when do they start? And like I said, this tool, which is great, is that it has a 3-month delay. We're looking at monthly candle, which means out of 3 candles we should have the reaction. Look at it. Just when we get out there, the Fed is acting immediately. They're slashing their loosening monetary policy. They're just stopping it. They kept doing it a little bit in here, God knows why, okay, but still the pace has changed immediately when the financial conditions were as good as reaching out the tipping top of our indicator here, okay? What's great is that, as you can see, the financial conditions normalize, they go back to the mean, okay? At that point, what happens is the market bottoms out, okay? Real great. Then what comes next is that, of course, as the financial conditions gets better, the market recovers, financial conditions get better, and then the Fed immediately starts rising rates again. What kind of effect does it have on price? Prices keep rising because the financial conditions are good, okay? And therefore the tightening isn't creating a market crash or whatever shit that is that I hear recently. So it's not going to cause a market crash when the Fed is going to rise interest rates. It's going to create a slowdown, okay? Which means whatever happens in here means that inflation away, the market valuations are still rising, okay? Just as they rise when the financial conditions will deteriorate as the Fed will rise interest rate over time. Okay, so the more the Fed will rise the rates, the worsen the financial conditions will be. But of course, it will, of course, work along with market valuations. The higher the market valuations, the lesser, the more the financial conditions will deteriorate as well. Okay, so 2 factors. Rising yields deteriorates the conditions, rising prices will as well. Okay, but rising yields does not bring prices down. It reduces the momentum. You start with hell of a momentum, kind of a recovery momentum, and then you shift it down because the tightening of the Fed's yields will slow down the economical returns of markets. And we look at the S&P 500 here, okay? So that's one thing to understand. When the financial conditions reach the limits, okay, what happens? The Fed stops buying. okay? They're not immediately selling. This is, of course, noise in here, okay? This never set a value in here. The market go back to the mean, and when valuations go down, the Fed immediately slashes interest rates again. This is the 2008 crash, and this one occurred in 2 steps. The first step is, oh, we're going to slash yields. Oh, Jesus, fuck, the market is still going heavily down. The credit bubble went down, so we have to do something more. Yields were nearing 0 at that point, so we had to find some new tools. And the Fed decided, okay, we've got a credit bubble trying to burst, so we're going to try supporting these bonds. Okay, of course, immediate reaction as the QE triggers, the downside price pressures stop immediately. Rates are at the floor bottom of 0% or near 0%, and prices stand for a very rapid recovery. There's one thing you need to understand about this structure is that anytime there is Fed balance sheet increase, this has very, very precise correlation with the money supply, okay? So understand that we reduce S&P valuation from this money supply. So when there is QE, actual S&P prices tend to surge because they double down on the actual money supply being increased and the valuations recovering from the massive dip that preceded. So understand that this is a double key school effect when we use QE and low rates, because we inflate the actual money supply, which doubles down on the asset increases. Okay, so understand it that way. Of course, back then, as yields were at 0 and that financial conditions were good, we had to maintain them as long as possible. The return to the mean took way longer than it did back then. Okay, remember that the recovery phase took just a few months back into the, okay, let me just delete that by the way, back from the 2000 crisis, the recovery was pretty quick. Okay, this time it took way, way longer. It took a couple of years to actually return to the mean. And the Fed has kept buying bonds all along, even when the financial conditions were back to normal. I think this was one mistake, getting addicted to this thing, which sounded so great. We figured out one way to stop the market from going down. So this is great, okay? And boost valuations and so on. Real great for capitalistic stuff. We just tried to stop the machinery, and well, when we did, it was like, okay, let's start it again. So that was real great. QE1, QE2, QE3. We really got addicted to cocaine back then. Of course, this hasn't been improving financial condition, it just has been maintaining it. So the question we might wonder is, what would have happened if we did not do this? If we did not, then probably the financial conditions would have worsened and we could have had another crash. So, of course, that's another story in a parallel universe. So we're not going to go down this road trying to figure out if the Fed did right or wrong, but the only thing we can say is that it has increased the valuation as much as it has increased the money supply. Okay? And until then, no one ever dare tried to rise interest rates. So maintaining rates at 0 and pumping money into the system to rise valuation, that's pretty much what happened. To the point that the financial conditions gone right back to so much accommodative stuff, the equivalent of this, then the Fed had to start tightening. How precise? Oh boy, that's pretty great now. Okay, we got a pattern, we got something that works pretty significantly, and we've understood how this QE stuff has been introduced in the perspective to lengthen the cycles. But that's all about it. It's just lengthened stuff for a little while. Now it sounds like it's making things more quick. Okay? So look at it. We are now able to predict when the Fed is going to start rising rates. We've got a pattern that is completing itself, and we've got kind of the cooling effect that is coming from money printing. Okay, then let's study what happened recently. Of course, financial conditions deteriorated as yield gone up. Okay, what we have in here is immediate price reaction afterwards, which means as the markets go down, the Fed is slashing interest rates. And as we have an unexpected bearish catalyst, which is, oh, COVID, and no one saw this one coming, of course, it got way worse than people thought it would. Government needs massive spending to cut the immense bills that were passing to cut down the pandemic effects. So there was no other choice but to directly intervene very strongly into the open market buying bonds. So the Fed has gone bold, very, very bold. I mean, look at this. I mean, the Fed's balance sheet had nearly doubled during the pandemic in just a short period of time. And the QE has eventually slowed down, but the Fed's balance sheet is still increasing at a very, very fast pace today. So let's ask ourselves the questions. Where are we today? We are in a point in which we have made financial conditions just as great as possible due to the double cooling effect of rates at zero and historical money printing. We've gone to so favorable financial conditions there that, of course, prices rebound severely. And don't forget that any increase in the purple line is a massive increase in money supply, which doubles down on the asset prices recovery. So V-shaped reverse, motherfuckers. Of course, prices have surged into the S&P 500. This wasn't even a question. Of course, this was just normal and due to financial conditions, which of course very rapidly recovered. Not the same cooling effects as the one back then, because we haven't gone easy on QE. We've gone hard. So we've burnt all the gas. What happened back then, after normalizing financial conditions, it's now too good to be true. We are back into the area in which, guess what? The Fed is going to start tightening. There's not even a question. It's there and no one can argue about it. It's going to happen at least within the next 3 months. We're going to get a rate hike. God knows how much. Because of course, as the Fed will start rising rates, the financial conditions will deteriorate. The question is, how fast? And more importantly, the second question, because that is the current motive in which I see people saying some absolute nonsense. Do you really think that the Fed is going to tighten the monetary policy over its balance sheet as well? Because I see some people thinking of it that way. No, it's not going to happen. There's still going to be QE, guys, because the best we can hope for is to flatten the curve. Meaning that the Fed will still buy bonds, but at the rate of their expiry. And they will specifically target short-term bonds due to the absolute near-zero perspective kind of rates. So is the Fed still going to directly intervene into the market and pump liquidity? Yes, it will. Is it going to keep pushing the money supply and therefore inflation? Yes, it will, because the Fed has no other choice. If the Fed is going for both tightening yields and the balance sheet, we're going for the biggest motherfucking crash ever seen. Remember that we are building the biggest and ever massive bubble of liquidity ever created in the entire market's history. So we rather like to be cautious about deteriorating financial conditions. Therefore, this is why the Fed is willing to act cautiously, because they know how dangerous the baby is if it ever drops down from the bath with the water. It's really the problem we have facing now. They know that actions may have very rapid actions. But pay attention to this. Look at the cycle. The next time we go there, we'll have no room to work with yields, because if we tighten, we're certainly not going to be able to tighten that much. Look at the overall pace. We might be able to rise yields a bit, eventually right up to a maximum of 1.5%. That's the best we can hope for. Okay? And even if we rise 1.5%, we're probably going to deteriorate conditions real fast. So there certainly isn't going to be such a thing as stopping QE. QE will just be reduced to the expiration rates of bought bonds. And likely the Fed is going to start buying more short-term maturities rather than going to long-term ones, which will even more rapidly force the yield curve to reverse again. So the Fed is locked from everywhere. They're certainly not going to be hawkish. They're definitely going to be kind of an in-between stuff in which they have to act on yields immediately, but they will certainly not act on the balance sheet. And that's one reason why there will still be inflation for the years ahead, because they have no other choice. They will not use the balance sheet as a reduction for tightening. Otherwise, the market will crash entirely. But the thing that you need to understand is that they can still use this as a cool down effect that will of course create more inflation. But if they want to delay the next bigger and more dangerous recession that is headed toward us, because it's not a question about if, these things always occur. The question is just when. When are we going to have the worsened financial conditions again? Because when it will happen, the next one might not be pretty. Because either we're going to have to find another magical tool like the ones we've introduced with QE, we're going to have to find another way, folks. Because otherwise, the financial conditions, if they deteriorate again with that much debt to GDP ratio, we're going to pop the bubble, folks. It's going to happen sooner or later. It's going to happen someday. But until we find another cool down effect, the next recession might be a very dangerous one. So understand it that way. Some of you guys are complaining about the complacency of the Fed's policy decisions. But do you really want the credit bubble to pop in front of your heads? You certainly do not want that. So try to understand a bit why they do it. Okay? So understand that it is inevitable that the financial conditions will worsen again over time. What they're trying to do is to slow down the process. And there are no magical ways to do it. It's either inflation, or we're going to have to find another set of tools. And that is everything you need to know about yield and yield curve, folks. What the Fed is going to do is there is no other choice but to tighten the yields. They will very likely have no big room to work around these things due to the historical pressures and the accumulation of debt into the system. Rising rates too high will pop the bubble, so they cannot do this. They will rise, but very cautiously. They will certainly not act above the balance sheets and certainly not trigger its reduction. Otherwise, that would be the absolute destruction for market valuations. Though, be real cautious about the Fed's action. What they will likely start to introduce as a narrative within the next few years is another set of tools, bros. Okay? So try to understand everything about it. What this other set of tools is going to do is very likely, once again, going to inflate the actual balance sheet of the Fed one way or the other if they try to buy another set of assets or whatever. Inflation is inevitable because anything the Fed does is going to increase money supply. And shrinking the rates will have very limited effect. And remember what we said, when the rates are rising out of very, very, very accommodative financial conditions, it does not create a crash. So, sorry bears, it's not going to happen. What we're going to get is a reduction of momentum. Understand it that way. Inflation will prop up prices, but the real returns depreciated from inflation, we're very likely going to stop within the next few years. So if you expect another 30% year returns on the S&P 500, that means a 30% inflation to get it. So it's not going to happen either. Okay, so cool down on absolutely stupid expectations for the years ahead. Definitely everything is pointing for stagflation. I hope you understand it now. That's everything for today. We're going to, of course, go right back to those conclusions when we make the year review. That's the reason why I wanted to explain all of the processes behind my personal forecasts. And of course, I cannot predict the future. This is a model, understanding that a model cannot be perfect. A model has its own flaws, but it has one great thing. It gives you at least a plan. That being said, this one tells us that at least 3 months from now, we're going to get rate hikes starting. We will see how long they will be able to do it until financial conditions deteriorate again. Okay, look for these things. I gave you all of the math behind it, so if you want to make it your own charts, feel free to do it. Bye, guys.